In this video, we're going to discuss how you can boost your earnings on a daily basis by day trading the SPX options. We're going to discuss several different steps you need to take to be able to be successful at day trading the SPX.
Please subscribe to our channel. Have fun trading and manage your risk.
We're going to give you enough of an understanding that you can be successful at it, but you're going to have to continue to study it. This is not a type of trade that is for beginners. This is a more advanced type of strategy to be able to make excellent returns on a daily basis, even in a volatile market. So we're going to go over several steps, and it's going to be almost a complete guide of getting you started with day trading SPX. But keep in mind, we are kind of giving this information over the weekend, and so this is not live. But today we wanted to take the time to be able to give you the information without the markets being live, so we can just focus on the steps you need to take. So you start off by typing in the SPX, and then what you're going to do is look at the option chain, and you're going to go and choose the 0 DTE. As I mentioned, today is a Saturday, so we don't have a 0 DTE, but it still will apply. The concepts we're going to talk about is still going to apply. And you're just going to transfer that to something that's expiring that day when you're actually doing it and doing it live. So what we normally do is go into the 0 DTE, and then our first step at the Dorian Way is that we check and look what the VIX is doing. So we take the VIX number here. So you can see this cash settled VIX, that's what we look for. We take this number to be able to determine what is the expected percentage move. And you can use this VIX rule of 16 on anything that's 0 DTE or 1 DTE. If it's more than 1 DTE, it does not apply. Okay, more than 1 day out, it does not apply. It's based on a 1 day percentage move. So if we take this 25.51 and divide it by 16, that's going to give us a 1.59% move, or basically a 1.6% move. That is what the VIX is saying the percentage move is going to be. It can be up or down about 1.6%. So from there, we go and we check what is the expected move on the option chain. So here on the TastyTrade platform, the expected move is plus or minus 51. Basically, it says plus or minus 50.90, so we're going to round that up to plus or minus 51. And then what we do is we check what is the straddle price, right? So this is how you can check the expected move if your platform for some particular reason does not have the expected move over here. And if it doesn't, then you need to find a platform like TastyTrade, like Thinkorswim, that allows you to be able to see that expected move. But if you do not have it, you can go by the straddle price, and you can just go to the at the money, buy the straddle, and that will be able to determine what is the expected move. This is kind of like the back of the envelope type of calculation if you didn't have it at the right corner of the option chain. Okay? TastyTrade believes they have a better formula than just this expected move, that this is closer to the one standard deviation, that's 68%. So, but at the Dorian Way, we like to look at the straddle price and then actually take that into consideration just as much as the TastyTrade or the Thinkorswim platform expected move. We actually look at this and say, okay, well, we're going to round this up. I know it's closer to 52, but we're going to round it up to 53 and say the expected move is 53. Then we're going to try to be, if everything is lined up perfectly, we're going to try to be at least 2 times the expected move away from at the money. So if you take this as 53 times 2, that's going to be 106 points away on both sides. That's what we're going to try to be, is at least 106 points away on both sides. So once we figure out the expected move and the straddle price and so forth, then we're going to go and set this trade up at the 5 delta on both sides. We're going to set this up as an iron condor. You can decide to determine which way the market is doing, and you can do a put spread first or a call spread first. But primarily the way I do it is putting on an iron condor first, because I don't know which way the market's going to go, right? I'm not trying to predict the market. I'm just saying it's not going to do what I'm doing with this iron condor. It's going to stay within this range. Okay? But nothing's 100% of the time. Sometime I will put on just split side first or just the call side first, but most of the time I'm putting on the iron condor because I'm not trying to predict what direction the market is going to go. So I'm setting this up, and I'm going to set this up initially with a 20-point wide spread. So this is the 37.85 here, and then the 37.65. So it's a 20-point wide spread. And then I'm going to go to the call side here, and I'm also going to choose a 5 delta and set it up as a 20-point wide spread. So that would be here. Okay? So we want to collect at least $200 per contract that we're doing, because we're going to try to make at least $400. We're going to try to make at least $400 using this example today. And how can you do that? Well, we want to get out of the trade once it's up 50%. Once it's up 50%. So if we only collect $200, so if we get out, then at 50%, that would equal $100. So we need to collect at least $400 to be able to exit the trade once it's up 50% or $200. And that's what we're trying to hit, is $200. And we're going to do this based on, we're not going to include fees and commissions at this time. It's going to be simply, you want to collect at least $400 or $200 per contract, iron condor contract. And then you want to get out of the trade once it's up 50%, right? So you're not trying to stay in this trade all during the whole trading session, the whole trading day. You're trying to get in and out. So if you get that 50% in 30 minutes, that's, more power to you. If you get it in 2 hours, okay, that's fine as well. You want to be out of the trade once you hit that 50%. Most of the time, that's going to occur way before expiration. A lot of times, that 50% you can hit that 50% within an hour to an hour and a half of the market being open. Okay? So right now we're only getting 170 per contract. So at this point, you can decide to do a spread that's wider on both sides, or you can decide to go closer to at the money. So in this case, let's decide, instead of doing a 20-point wide spread, let's do a 30-point wide spread. So that's giving us 185 now. Then we go to the split side and we do a 30-point wide spread. That's going to give us here. So now we have the 200. Okay? We have the 200, and if we did two contracts, and on the TastyTrade platform, you go over here to add the quantity. So we're going to add two contracts. So now we're getting the 400, that we want. Right. So if we get out at 50%, we'll get the $200 that we're looking for to be able to make $200 a day per week. So if we had a 5-day trading week and we were able to win every day, that would be $1,000 that we make that week. Right? So, but this example is just based on how you can make $200 trading the SPX on a daily basis. Okay? So this is the process you would be able to, at this point, set up how far you're away. And so now we want to see what percentage this is from at the money. We said that the VIX said 1.6% basically. So we're going to see how far this is from at the money. So we just do a basic percentage calculation. So you take this short number, this strike here, this 37.85, and you subtract it from the last price, and then you divide it by the last price, right? So we're going to take 37.85 minus 39.16 divided by 39.16, and that's going to give us 3.3% away on the put side. So that definitely meets our criteria of being more than 1.6% away on the put side from at the money, right? So we're 3.3% away on the put side. And then on the call side, if we take this short number, this short strike number, it's the 40.10, and once again we subtract it from this last price and we divide it by this last price, right? So we take the 40.10 minus the 39.16 divided by the 39.16, and we get 2.4%. So we're closer percentage wise on the call side, but we are still more than what the VIX is saying. The VIX is saying 1.6 basically. We're 2.4% on the call side away from at the money, 3.3% away from at the money on the put side. So we do not have to make any type of adjustments at this point, because we are far away percentage wise. We are at least 2 times the expected move. Let's check that really quickly. So we said the expected move is about 106. We wanted to be, because that was the straddle price of 53. We said 2 times expected that, so 106 would be the case. So if we take the 39.16 and we add 106 to it, that's going to take us to 40.22. So we're not 2 times the expected move on the call side. As you can see, we're inside of that, very close, but inside of that, right? And then on the put side, if we take that 39.16 minus 106, that's going to take us to 38.10. On the put side, if we go over here, you can see we're at the 37.85. So we are more than 2 times the expected move on the put side. So at this point, you can decide, do you want to move the put side up towards at the money more so you can move the call side away from at the money some so you can be 2 times the expected move on both sides, or do you want to just keep it the way it's set up, right? So in this case, we're going to keep it the way it's set up, and we're going to be happy with the percentage we're away from at the money on both sides. Okay? So once you happy with the trade that you have set up and the prices you have set up, and you send this, once you send it, then you have to immediately come in and put a stop loss order. Okay. So you can automatically put the stop loss order at 300 per contract. Okay. So 300 per contract. You can put a iron condor stop loss on for 300 per contract. You have 2 contracts, so you want this to be a total of 600. Once you down 600, you want to say uncle and get out of the trade. And you do not want to lose more than 300 per contract. This is how you scale. This is how we teach at the Dorian Way, right? So, and this is all based on your account size, right? So normally you do not want to lose more than 2% of your account at most. But obviously, if you're doing this with a smaller account, then you might have to go up to 5%. But you shouldn't be doing this in the SPX with an account size less than 25,000, because then you would run into the day trading pattern rule when you have to adjust, and you will have to adjust eventually on these trades, on these 0 DTE trades, because the market can go in either direction a big way, and you're going to have to make small adjustments. Okay? But if you're going to do this with an account less than 25K, you need to do it in the ES, because then you don't have to deal with the day trading pattern rule. We have other videos regarding that, so I'm not going to touch on that very much here. So once again, you want to get out if you are down 300 per contract or 600 total for this trade that we're trying to make $200 on. Okay? If you're down 600, you say uncle, you move on. You did not win on this trade at this point, but the probabilities should work out for you. You should be able to win on a consistent basis. So for example purposes, if you did 10 trades and you won 8 out of 8 out of 10, would that be 80% of the time? Well, so that means 8 times 200. That's how much you would make. So you would make about $1,600, right? And then the 2 times that you lose is 2 times 600. So you would lose $1,200. So even if if you hit this win rate of 80%, you would still make $400 out of every 10 trades. A lot of times you're going to make the whole 1,600, because you're not going to lose the 2 times, or you might only lose once. So keep in mind. But if you do lose twice, this is how you can have a positive expectancy, and this is how this trade plays out. Okay? So once you put your stop and you're out of the trade, then you're done with the trade, right? You reach your stop. If you have an automatic stop, you're just going to let it play out. You can have a manual stop, but if you have a manual stop, you have to have the discipline. You cannot do this trade without the discipline, or you will blow up your account. You will lose too much. You have to have the discipline. What we like to teach at the Dorian Way is that if your stop is $600 in this example, and that's based on your P&L day. So you will go over to your account and you will look at the trade that you're in, and it'll be under the P&L day. So if you made any adjustments, your P&L day will still reflect how much you're up or down. So if you're down 600, that's where you ring the register. You say, all right, we're done. We have lost for that day. Okay? If you are making adjustments, you want to make them before you're down 600. You want to make adjustments like when you're down 400, when you're down 500, stuff like that, so you can let it play out. You can give it time to play out. But once you're down 600 on that P&L day, you say uncle, you move on, so you can keep the losses at a small percentage. And you can keep the losses at a small percentage. And once you hit the 200, once you up 200, once this is up 50%, you get out of the trade. That's how you win, and you move on. You do not want to be greedy. Right? You're not going to try to get the whole $400, because that's just going to keep risk on the table through the whole trading day. Get out at 50%. That's going to give you a higher probability of winning. That's going to make your probability most of the time, more than 80% of the time, you're going to win on this trade. Okay? So this is what we teach at the Dorian Way. It's obviously a little bit more to it regarding adjusting and so forth. And we talk about that in other videos, but you can also learn that if you decide to join the Dorian Way. But we teach members how to make consistent income day trading, using other short-term type of trading, and using swing trades for 30 to 60 days and things that are longer term. But this is what is really exciting, because you can make huge percentages on this type of zero DTE trading if you're doing it correctly, if you have the discipline to do it correctly. If you do not, if you don't understand what you're doing, do not do this trade, because you can lose a lot of capital, and that is never a good thing. All right, thank you for watching this video. If you like it, please subscribe and like the video, and we'll see you in the next one. Bye for now.